So Vern, let's talk about the blind spot here for Australian investors. Many Aussie clients, they'll think that they've got EM coverage because they hold the MSCI World ETF or some global active fund. But why does that actually leave them, with actual, short when it comes to true EM exposure?
That's something you hear quite a lot, where people say, don't worry, I've got emerging markets covered because I own a global equity fund. But for a passive investor in something like the MSCI EM index, there's only about a 10% allocation to emerging markets. In the world index, only about a 10% allocation to emerging markets in the world index. So you don't get a lot if you go the passive route. And you might hope that your active manager is giving you greater exposure than that, especially given the opportunities that abound. But that's also not the case. So we looked at the top 10 actively managed, most commonly used funds in Australia by investors and advisors. And on average, you only get about a 6% EM exposure through those funds. So even less than with a passive approach. And if you look even closer at those top 10, only 2 of them are actually overweight emerging markets, where 5 of them have sort of zero or very close to zero exposure to emerging markets. So it's probably fair and accurate to say that emerging markets are deeply underrepresented in many portfolios, and it does present that potential blind spot.
So then some people will go a step further and they'll buy an emerging markets index. So we've spoken about on the show before around like where active and passive makes sense in different contexts. Give us a bit of the color on buying an EM index versus going with a active manager to get your EM exposure.
I think in emerging markets, you might want to be a little bit more discerning when choosing where to invest and what to invest in, because in EMs, passive investing can potentially be a little bit riskier than in developed markets. The indexes are cap weighted, as with most indices, so there's a handful of companies that dominate the indices. So in emerging markets, for example, state-owned enterprises are overrepresented in these indices, and that's often where governments don't care about shareholders all that much, so you might not want to be there.
Or they care about one shareholder in particular themselves.
Yes. So that's not really, maybe not where you want your clients' money to be invested. With a passive approach, you also get a fairly big chunk in Chinese equities, which has tricky politics and governance issues. There's a big chunk in Taiwan, obviously a tiny little island fairly closely connected to China. You also get a big allocation to India through a passive approach, which is the most expensive emerging market in the world at the moment, almost on par with the US. And then you also get a big chunk in banks, which are often highly leveraged to local economies. So that's of what if you end up investing $100 in an index, that's the default split that you get. And you might just want to ask yourself the question, how comfortable am I with that default allocations I'm getting in emerging markets, given the emerging market specific risks and concerns?
Well, perhaps if you could provide an example of a company or companies that you're currently avoiding that do sit in the sort of passive market cap weighted indexes.
Yeah. So for the EM index, the front row is essentially chips, clicks, and rupees. So you get Asian tech hardware, you get Chinese internet, and you get Indian financials. But there are a handful of companies at the top of the index that we don't own. Things like Alibaba or Xiaomi. I'm never sure if I pronounce that correctly.
Xiaomi, yeah, whatever.
Xiaomi.
That one.
Yeah.
Both Chinese listed companies that we don't hold, and they are pretty big members of the index. But our biggest underweight is India. We hardly hold anything in India, essentially zero.
Wow.
And then you compare that to the index weight of about 16%. So it's a fairly big diversion from the index benchmark and from other managers out there. We just find India quite expensive on a variety of valuation metrics. So it's probably not unsurprising that a manager like us is struggling to find many attractive opportunities there. There will be, and there are companies in India that we would certainly love to own, but it has to be at a price that makes sense.
Yeah, yeah.